Higher premiums and fewer death benefits have led to reduced payout ratios on individual life insurance policies since 2020. That despite concerns about COVID-19 and elevated mortality in certain population segments, according to a new AM Best report. Joining us today are two of the analysts behind the report. Senior Financial Analyst Stratos Laskarides and Industry Research Analyst Helen Andersen. And Stratos, there was anticipation that COVID-19 was going to have a big impact on mortality levels and thus have a big impact on life insurers' financials. But that really wasn't the case, was it?
Yes, John, that's right. What we saw in the report is high premiums, as you mentioned, fewer death benefits led to reduced payout ratios. This was since 2020 through the end of 2022, despite the concerns about COVID-19 and elevated mortality in certain population segments. And we noted that the impact of COVID-19 on life insurers' individual policy claims has been less pronounced than some may have initially expected, although the pandemic has resulted in elevated mortality among certain demographics. And insured lives mortality has been running lower than the general population, something that's been widely noted in the industry already. And that's owing largely to the effect of the selective underwriting and sales methods that insurers have adopted over many years. But mortality rates have risen. They since the onset of COVID, obviously it's been widely documented and discussed already, but thus far it's been a manageable drag on earnings in aggregate for individual life insurance business. And what we noted in the report is this was evident from a drop in the payout ratio, which compares death benefits to net premiums written, which fell to 48.9% in 2022 from 53.7% in 21 and 55.7% in 2020. And obviously questions still do remain about the near and long-term impacts of the pandemic and pandemic-related mortality experience on assumptions of future pricing. And evidence does indicate different approaches to insurers' mortality assumptions, as some companies have updated those assumptions for the pandemic experience, while others have not. And another thing to note is that this is based on US statutory data filed by the US-based life insurers. Other considerations are reserving, including incurred but not reported reserves, which doesn't necessarily come through in the death benefits paid in a year. And offshore reinsurance could be factors as well that could include additional claims. And the impact on morbidity claims is another factor to consider. But nonetheless, insurers over the past 4 years have been doing exactly what they've been meant to do by paying COVID and non-COVID related claims to help protect families. And they've been selling more policies to help close mortality protection gaps.
Helen, the report also talks about first-year premium growth levels and renewal premiums on individual life insurance policies. What were some of the takeaways from the report there?
Following a record high in 2021, first-year premium growth dropped significantly in 2022, partly attributable to the impact of inflation on household budgets. Renewal premium growth on individual policies also declined moderately and had been consistently positive over several years. In 2021, this level increased to its highest point in a decade, as many policyholders valued retaining coverage during a pandemic.
In the world of individual life policies, what shifts have you noticed there as far as distribution of products, if any?
Whole life premiums still constitute the majority of insurers' ordinary life premiums, owing to the higher costs associated with the longer-term nature of the coverage, in contrast to term insurance, which has a set period of time. The face amounts of whole life policies can vary widely. On the high end, for example, participating whole life policies, particularly those sold by mutuals, can be targeted to higher net worth individuals. The final expense product has also grown in attractiveness as the population ages and retirees seek additional mortality protection. Term life insurance was incrementally more popular in 2022 as it provides mortality coverage at the lowest possible cost, a great value when one's budget is constrained by inflation. Variable life products, which can transfer investment risk to the policy owner from the insurer, was less popular in 2022 given the uncertain investment markets. Index life, which can provide some downside protection to investment volatility for consumers in exchange for a capped upside, made up a marginally larger share of total premiums in 2022.
Helen, Stratos, thank you so much for taking the time to speak with us today.
Thanks, John.
Thank you.
That was Senior Financial Analyst Stratos Laskarides and Industry Research Analyst Helen Andersen. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.